I'm Charlotte McLeod with the Investing News Network, and you're watching part 2 of my latest interview with Adrian Day, president of Adrian Day Asset Management. Part 2 covers strategies for investors in the current environment and recent trends like M&A activity. We hope you enjoy. You've given us, I think, a pretty good picture of what is going on in the world right now. I'm hoping maybe now we can shift to what investors should be doing. I know you're a fan of royalty and streaming companies, so I want to start by asking about those. Part of their appeal, I think, lies in the fact that they're usually not exposed to the same risks that mining companies face. And I wanted to ask, during the coronavirus, when they may be working with companies that have mines that have been affected, how are they still a safe investment? Are they still your favorite kind of choice? Where do you stand on that?
Yeah, I think so. And certainly they've been hurt. You know, all of the big ones: Royal, Franco, Wheaton, Osisko even more. But all of them had 30 to 35% of their production, what we'll call production, shut down was affected by mines closing. An amount. But I think two things are really important to recognize. One is, as you mentioned, in the case of royalties, they're not responsible for all of those additional costs, unless it's a net present, a net profits, which most aren't. They're not responsible for all the additional costs of closing, of maybe paying some of the workers for care and maintenance, all the costs of negotiating with the government and everything else. They're not responsible for any of those additional costs. For the royalty companies, it is, for the most part, simply a deferment of the revenue. So they missed 30% of their revenue, and now incidentally is beginning to come back. One mining company, I think, said 9 of their royalties were had been shut down, but 5 of them, this is 2 weeks ago, 5 of them were already starting up again. So it's beginning to come back. But the first thing is they're not responsible for those additional costs. And the second thing is, and believe me, there are additional costs in closing down a mine, putting it on care and maintenance, and then restarting it, and instituting new health and safety regulations and everything. All of that costs money. And then for the royalty companies, it's simply a deferment. So yeah, I think they remain the safest area in the mining space.
Okay, that's a good explanation. What about other gold stocks right now? We one of the other things we keep hearing is that gold stocks are going to start to move. And I guess the question that I have is, what precautions should investors take to make sure they don't get caught up in the hype and make potentially bad decisions?
Whoa, that's a big question, isn't it?
Well, you can choose to go how you want with that one. Maybe
there's a couple of things I can think of. One is, and this isn't directly to your point, but I think we've been through 6 years of very bad markets in the gold space and in the gold stocks, and some of us, such as myself, have been very, very used to being very, very disciplined on prices that we pay, and we've also been reasonably quick to take some profits. I think with the changed environment, those of us who've been around the gold space for the last several years, let's say we need an attitude adjustment. If gold is going to go to 1900, 2000, 2200, then it really will not matter whether you pay 26.70 or 27.30 for Barrick. The important thing is that you own it, not that you saved yourself 10 or 20 cents. And similarly, I think we need to be a little more careful about taking profits too quickly. So that's the first thing I'd say. The environment has changed, the sentiment has changed, and it's more important that we're in the sector than being too picky on price. And I almost hate saying that. It's almost heresy, isn't it? I think what to look for is the same sort of thing as we always look for, which is good managements and good balance sheets. I mean, balance sheets are going to continue to be very, very important because, we've seen a lot of companies do deals in the last month. They've all been oversubscribed that I know of. So there's a lot of money out there for the space, but that's not going to continue forever. I mean, and of course, raising equity always dilutes, always. So you need companies that have good balance sheets. That's essential, I think. But I think other than that, it's the same sort of thing. You focus on the quality and good managements and good balance sheets.
One thing I've heard a little bit as we go into this stronger market for gold is that companies seem to have learned their lessons from the last bull cycle. Do you think that's true? Are they smarter now and they know what to do for this round?
Well, yes and no. I think definitely most, well, if you look at the major mining companies and even the intermediate mining companies, I mean, most of those have new managements. Managements was fired, basically. We have new management. Balance sheets are much, much stronger today. By and large, the balance sheets of the mining companies are much stronger today than they were back then. There's much more of a discipline on what you're prepared to pay for acquisitions. And we've even got the start of this no premium merger, right? Merger of equals. It's never a merger of equals. There's always someone taking over someone else, but no premium acquisitions. So I think there's definitely more discipline in the mining sector, no question. Having said that, how long will that last? I'm a cynic, and I think when we're at 2,000, 2,200, 2,500, and all investors are saying, where's your next mine coming from? Where's your next mine? We're going to go back to what we were doing in 2010, 11. We're going to be overpaying for marginal assets, but that's in the future. That's not now.
Okay. I'll try not to keep you too long, but I do have one more question, which
That's okay.
is okay. You mentioned we've seen some mergers and acquisitions recently, and we did, I think last week there was a little bit of a flurry of them. What are your thoughts on those? What does that activity tell us about what's going on in the gold space, where the industry is at right now?
Well, a couple of things. I mean, one thing is it tells us certainly that with the coronavirus and the lockdown, some companies are vulnerable. But I think more importantly, it tells us that the producers, the big producers and the intermediate producers all recognize that in order for them to stay where they are, they cannot stay where they are by just developing their own assets. They have to go out and acquire other assets. And it may be the acquisition of a large company, or it may be the acquisition of a particular project. But as an industry, we are not finding the ounces that we're producing. And of course, since it's a wasting industry, you have, just to stay where you are, you have to find the same number of ounces that you produce. In fact, you have to find more because of wastage, but you have to find the same number. If you produce 7 million ounces a year, you have to find 7 million ounces. And that is as close as impossible as it comes in today's world. So we're simply, as an industry, we are simply not finding the number of ounces that we are producing. Therefore, the only way for big companies producing 2, 3, 4, 5 million ounces is to go out and buy those ounces, not to find them. So I think we're just going to get more and more and more of that as the price goes up.
Okay, and just a little side question on that. Would you think that some of them will be deals that are happening because of circumstances created by the coronavirus? I guess the question is, would they be happening if we didn't have these interesting circumstances?
Well, it's an interesting point. I mentioned that at the beginning, but then after I said it, I sort of thought maybe I shouldn't have said it. It's a strange thing. A lot of the people that I've spoken to in the industry, people I know, have said but they don't intend taking advantage of the companies that have been hurt by the crisis. And in some ways, I find that a very odd attitude. I mean, eat or be eaten. And if you're looking at an asset and you want to buy it, well, you take advantage of misfortune, don't you? But I honestly don't think that's had a big role. I honestly don't think that's had a big role. I think a lot of these deals, they've obviously been on the plate for a while. And the other part of it is, if you weren't already looking at an acquisition in January or February or early March, you probably have not completed that acquisition during lockdown because, you can't do your due diligence. So you can't get on the ground and do your due diligence. So unless you had already been looking at something, it probably didn't happen.
Right. Okay, that makes a lot of sense, actually. Those are all the questions I have. And unless there's any final points that you want to leave people with, I know we've been talking a lot about gold, which is not the only thing that you look at. Just if there's anything else you would add.
No, I mean, just to really emphasize it, I do think we've had a fundamental shift in the market. We'll get corrections, and we've got to be prepared for those corrections. And the corrections will come just when you finally put your last dollar in. That's when we'll get a correction. So we'll get corrections, but the market has changed. This is not a full start. And I think the important thing is to be invested in the quality. You can always sell off the bad ones and put it into the good ones. But the important thing is to realize that this is a changed market.
Okay, great. I think we'll leave it there then. Thanks so much for being here.
Well, thank you.
Oh yeah, thank you. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Adrian Day with Adrian Day Asset Management. Thanks for watching part 2 of my interview with Adrian Day. You can click below for the link to part 1, which covers what could be next for gold and how that relates to what's happening economically.